Oh, yeah, people are having issues with the Zoom link. Yeah, Diane, we switched it out in the middle and probably a bad idea, but I'm hoping that everyone got the text and that they're able to stream. Adrian, I'm wondering if it may make sense because of the Zoom issue to see if once everything is set up, if you can go in and even if it's like 5 minutes in, if you can go in and send out the Zoom link to the people who didn't get the We Are Live text, just in the interest of making sure everyone has access to the link. Because I know we only sent out the We Are Live to a small subset, but for everyone else, if we could send it out, that may be beneficial. But we're good to start
Okay.
streaming, Adrian. Let me know when we're ready, and then I'll get started.
All right, yeah, we are live.
Okay, perfect. Thank you for letting me know, Diane. Nice to see everyone on here, Claudia, Preston, Steffi, hey Zach. Oh, it's so always a comfort to see your face on there. Caleb, Kirian, so many new people. Before we get started, guys, if you can drop in the chat, just tell me where you're from. Typically, I know a lot of people. Hi, Geeta, on here. Hi, Neckpen. So nice to see you on here. Jay, Ravi, Julia, exciting, excellent. Sunila, hi, Rusham. Okay, perfect, guys. I'm going to get started in the interest of time. I'm very, very excited about today's talk because, after the elections, this is something I was really doing my research on. Very excited to share everything that I've learned in terms of forecasts, projections, how things are shifting. There have been shifts. We're already beginning to see shifts in terms of interest rates, and that is shifting how we're acquiring. Hopefully, many of you were live when I talked about the updates we had for our current deal, and a lot of that is also related to elections and how things are pivoting since the elections. So this is going to be relevant to all of us, those of you who own real estate directly, those of you who are investing in syndications. So I'm very excited. As always, guys, a lot of you are on here live. That's amazing. We're going to have tons of time on the back end for Q&A. So make sure you drop um, we may need to mute someone, Adrian. If you're a host, you can go ahead and keep doing that. But everyone on here should automatically typically get muted. But if you are unmuted, make sure you do. But keep dropping your questions in Q&A. We have a diverse bunch of people on here. Some of you are very sophisticated, own multifamily. Some of you are just getting started. And so, any question you have relating to real estate, feel free to drop it in. I'll make sure I'll get to it. Doesn't have to be related to what we're talking about. And those of you who are watching this on Facebook, make sure you drop hashtag replay in the comments and then put your questions in, if you're on YouTube or Facebook, put your questions in the chat. And Adrian is going to be gathering all of those questions for me. And I'll make sure I try to answer as much as possible on the back end. And then if you're live with me on Zoom, sorry about the technical glitch. We are sending out text messages so you're getting the right Zoom link. We just wanted to simplify the process so you don't have to register to get in. And in the process, I think we created some confusion. But if you're on here on the back end, you can always raise your hand. You can unmute and we can have a conversation, which is why we run these meetings as Zoom meetings and not webinars. Okay, with that being said, let's get started, guys. Adrian, I'm good to go, right?
Yep, you're good to go.
Awesome. Thank you. Okay, perfect. Now, like I said, I saw so many faces on here, names that I don't recognize. I know our community is constantly growing. So I'm going to do a quick intro and then we'll get to today's main agenda and main topics. But for those of you who don't know me, I'm Param. I'm a radiologist in Southern California. I got to financial freedom at 41 using real estate, and since then went on to build out the Generational Wealth MD community, and we're growing really fast. We are predominantly physicians, but we have a lot of people, other professionals, tech space, lawyers, and the goal is to help educate people and provide them with opportunities so we can all really accelerate our wealth building, but more importantly, our passive income, growing our passive income to get to that point of financial freedom. GW Capital is is the part of the community where we bring vetted opportunities to our members, and that's through syndication opportunities, predominantly multifamily at this point. We are now at over 1,500 doors and 300 million in assets under management. 2024 has been a great year. We've been going in buying solid assets, very low risk, but still in a lot of them in that value add spectrum. And I'm going to talk about my theses and about how I think you should be approaching real estate going forward in the next few years. But the overarching theme, and I always like to zoom out first, is that like many of you, and I was on phone calls with many of you today also, and the story is so similar. 10 years out of fellowship, I was just following the traditional retirement path, investing in the stock market. And when I got to the point where I had a rough career transition, I realized that I would have had to do that for another 17 years to get to the point of financial freedom. And there was no way I wanted to be in that position or I could afford to be in that position. And I pivoted. I shifted my asset allocation. I started leaning into real estate and I got to the point of financial freedom in 1 year. And that is the power of investing in real estate. There are many ways to do it: direct ownership, passively in syndications. But the goal of all of that is to reduce the time it takes you to get to financial freedom, right? And I was talking to someone today and said, is it really going to be impactful even when I invest passively? It is, because it cuts your time in half, right? And so that's the crux of what we do. That's the point of the education, point of the community, is to really break down those barriers to investing in real estate. And if this slide may seem very repetitive, but this is what we're doing. We're trying to get everyone to the point where you have a more balanced asset allocation instead of primarily being invested in the stock market. We want to get you to the point where your portfolio looks similar to that of the ultra wealthy, which is where you have, and it doesn't have to be 50%, right? 30 to 50% of your assets in real estate. So you get higher returns. So you accelerate to financial freedom. So you're reducing volatility in your overall portfolio. Remember what happened in 07 and 08? A lot of my attendings could not retire and they had to wait a few years because they were concentrated in the stock market, and so that you can tap into the tax efficiencies that real estate provides. Okay, gwcapital.com/guide. If you are thinking about investing passively in real estate, if that's your first step, this is a wonderful tool. It's a labor of love. I put a lot of time and effort into it, and it walks you through the process of doing your own due diligence. And I hear a lot of you say, Param, we trust you. And that's amazing, but I want you to know what you're doing. I want you to understand the lingo. And so if this is a great tool, there are books that probably take, the Hands-Off Investor, I believe it's the Hands-Off Investor, Brian Burke, amazing book, but this is like condensing all of the information you can find through multiple resources into like 1 to 2 hours of focused reading. That's all you need to do to really understand what we're talking about, right? And so please lean into that. Today, I'm going to talk about the agenda shortly, but 2024 has been really a year of growth for GW Capital. We scaled to 300 million in assets under management. We acquired 5 solid assets, and we started GW Capital Fund 1. And the goal of the fund has been really to help negotiate better returns for our investors. So now more consistently, you're hearing us say, GW investors get preferred returns, higher preferred returns, higher returns, and we're able to do that because of the fund. And and so we're constantly, the goal has always been to help our investors get highest risk-adjusted returns, help with diversification. We're working with more partners, entering newer markets. We're underwriting different asset classes, but again, the goal always has to be low risk deals where we're getting higher returns, and that has been the benchmark. And so when we find the right asset class, we will start expanding into it. But again, with the fund, we are constantly focusing on capital preservation, helping you build a recession resilient portfolio, both through education and through the opportunities we provide. But the crux of this is a great time to be investing in real estate, and we really want to break those barriers so you are able to take action. Okay, Adrian, would you be able to mute anyone who is unmuted? Thank you. Awesome. Okay, guys. Without further ado, GW Capital Fund 1 has been really amazing in terms of allowing us to get a preferred position in a lot of deals. That translates to you, our investors. The team spent months trying to reduce costs as far as the fund so that doesn't get passed on to you. So that whenever we say you're getting preferred returns, it means that compared to the retail investor, net of all fees, our investors get better economics, right? You will get a single K1, a lot of different things geared towards improving your experience as investors. And and we're really, really proud of it. And we're very grateful to you for helping us with GW Gives, which is our charitable mission. And we're constantly working on new projects, but the mission has always been to help children with disabilities in rural India, and you make it possible. Okay, let's lean into today's agenda. I wanted to start off with talking about the impact of the elections, Republican Trump's administration coming into power, and how that's going to affect real estate. We're already seeing changes related to that, and we're pivoting. And a lot of it is very, very, very exciting. I don't want to jump the gun here, but from tax policies to to being pro-growth. We're very excited. So I want to deep dive into that so you have a little more direction. Then, as always, we're going to go talk about overall macroeconomic trends. And then we'll talk about multifamily fundamentals. And then for all of those of you who are our investors, I'll do a quick recap of all our assets. We do this on a quarterly basis, and that's because we want you to really understand what's happening with those assets, but also give you the ability to really ask us questions and get all your concerns answered. And then again, on the back end, tons of time for Q&A, so make sure you're dropping all your questions in. Okay, before we get started, guys, and really start deep diving into today's topic, Cortland Vizcaya is the asset we currently have available to invest in. It's in Houston. Those of you who've attended our previous webinars, again, higher preferred returns for our investors. But this is there are updates about the deal, so I wanted to make sure I highlight this. Some of you on here are already have already funded and are in the deal. Some of you have soft committed and are getting the paperwork done. And interestingly, a lot of these updates are directly tied to the election results. Okay. And that's because interest rates to the 10-year Treasury rates spiked up after the election, and they went up by over 50 basis points within the last 4 weeks. What that did is that it changed our debt terms, right? And this is happening across the market. This is affecting everyone who's underwriting deals right now or who's potentially looking to close at this point. And initially, we underwrote the deal for a fixed interest rate, 7-year debt product, agency loan. Again, very conservative debt terms. But with the spike in Treasury yields, we had to go in and rewrite this. And so what we were able to do, which is very, very exciting for all those of you who are considering this, considering that this is a lower risk deal with significant value add returns, right? We were able to negotiate a $1.5 million discount from the sellers, and that's because the lending environment has shifted since the election. And we have now changed our debt structure to put in variable rate 10-year debt from Freddie Mac with 5 years of interest only. Initially was 1 year. And a 3-year rate cap. What does that mean for the next 3 years? When interest rates drop, that's going to affect us favorably. But if interest rates go up, it's not really not going to affect us. So it's synthetically fixed, but allowing us to take advantage of rates dropping, which we do anticipate happening as the Fed goes on continuing to cut rates, right? And I'm going to talk more about that later. But it also gives us the ability to have flexible exit options with this asset. So end of 3 years, if it's the right time to sell, we could sell without having any significant prepayment penalties. So considering the interest rate environment, considering the election results, everything factored in, we have debt, which is likely the most favorable for the current environment, allowing us to go in with more built-in equity because of the discount we were able to negotiate. What it also does is, if we had gone in with 6.4% fixed interest rate, which is what we would get at this point, because of the way the lending environment has shifted, cash flow would have dropped to 4% average cash flow. With the new debt product, we're going to be at an average of 7% cash flow during the hold period. And that doesn't factor in the back end where we're going to get equity split, right? And this is, again, the DSCR for the deal improves because of that. We're reducing loan proceeds by 1.6 million, so that's more equity in, which is a good thing. All of this is very favorable for the deal, just makes it a little more exciting. And another update is that a closing has been pushed to December 16th, so we have a little more time to fund. So our funding deadlines have shifted a little bit, giving all of you, especially those of you who are looking at investing through your IRA, you have a little more time there. The meeting to get, and so the goal with this asset is, and the amazing thing is that this is a second asset similar to Cortland Med Center. I know some of you were in that deal. We're going in with the plan of reducing property taxes from $1 million to $150K day one before closing. That gets approved. That is on the dock for December's meeting with the Houston Housing Authority. And so by doing that, we're bumping up net operating income by 37% day one, right? Okay, so that is again very hard to come by these assets with this play. So we're excited that this is our second asset where we're able to do it. Again, the window on that is narrowing because we probably won't see a lot of these deals going forward. So excited to get into it. For those of you who are in the deal or have considered it, the investor returns have shifted a little bit because of the debt product being different. So you will get on average around about projected 7% cash flow during the whole period, and then the equity split on the back end, which the goal is to almost double or more than that, more than double your capital over the whole period, right? This, again, if you need access to any of this, guys, shoot us an email. We'll more than happy to hop on a call for those of you who have questions about how this has shifted. But the asset, the market, again, just such an, a solid asset. Katy School District, some of you are from Houston, and I met you when I was out there a few weeks ago. It is the #1 rated school district in the Houston MSA. A lot of energy and healthcare jobs. And again, with this presidency, there are going to be more energy jobs, more manufacturing jobs, all of which directly benefits Houston. So very favorable for the, for this submarket. And then the asset per se is also very low risk. Again, we're always looking to de-risk. It's a high cash flow asset. We got a discount on it more than what we already were at because we were already going in at a 160K per unit basis, as opposed to 200K, which is the average of sales comps in that area. High occupancy. So just a top-notch asset. I'm going to quickly go past this. Anyone who is interested in learning more or want to learn more about how things have shifted, again, the shift is directly related to what has happened since the elections. And so if you want to understand this better, feel free to go on to gwcapital.com and hop on a call with us and we can deep dive further. The tax benefits, the way it's projected right now, we do hope to get about, for every 100,000 invested, 40,000 in passive losses, right? Passive losses, which can be used against passive income. So you're not paying taxes on your passive income. Now, with the Trump presidency, and they're already working on expediting law, which will bring back 100% bonus depreciation. And that has bipartisan support, so that will most likely pass. Again, they tried that earlier this year. It didn't pass because there were other things in the bill that kind of held things back. We're hoping this passes, which may mean that retroactively we could get more. We could go back to 100% bonus depreciation. We'll know more with time. But that being said, even the way it stands, this is the way the tax code currently stands without any changes. This is the last year for 60% bonus depreciation. So if you want to tap into that, make sure you're soft committing. We're currently on a wait list because the last day for soft commit was the 19th, but you can get on the wait list. At this point, it's first funded, first served. So if you want to get in, make sure you're getting the paperwork done and funding as soon as possible. And December 1st is the last day to fund. Our target closes December 16th. So again, exciting updates, a lot of that related to what happened with the election and shifts in lending, but all very favorable. And we were able to pivot and really negotiate better terms for this deal. So that's exciting. It's gwcapital.com/Houston and the number 2. Quickly, some of you are exploring, were exploring Vizcaya and townhomes, which is the other asset that we have in Dallas. The townhomes is a lower risk, and I talked about this 2 days ago when we did our webinar, but quickly, the townhomes is a lower risk asset with slightly lower returns, right? So if that's the risk profile you're looking for, that's what I would go with. This is also the deal that has a higher cash flow position, which does not have the profit split on the back end. Vizcaya is more our, your traditional core plus asset, but it's getting value add returns, right? So slightly more calculated risk, but higher returns. And if you're looking to grow your capital faster, then that's the deal you want to be going into. Now, with the Dallas deal, we probably have another, and this is because IRA funds are taking longer and we have a tight deadline. And so we likely have about 100K of space left in Class A, which is your cash flow position. If anyone is looking for 10% more guaranteed returns that get paid out first without really looking for that back-end equity split, that's for anyone who is risk averse or who is really looking to live off the cash flow. Cash flow is more important to you than doubling your money in 2 years. We have about 100K left in Class A and another 100K left in Class B for this deal. And so again, reach out to us. book a call if you want to discuss it. But that's the risk return profile. And I just wanted to mention that. Okay, moving into what I think for me, more than anything, this is something that really excited me. As real estate investors, again, our decisions, and I'm going to talk about this, your decision to shift your asset allocation really should be based on the fundamentals of investing. But it's still exciting to see how policy changes could affect real estate investors. And honestly speaking, all of us have experienced this. 2017, 2018, and the boom, the tax incentives, a lot of that was very pro real estate. Again, economic outlook for this presidency is very pro growth and pro real estate. And a big part of that is going to be tax incentives, right? Like I said, they already have something in place where they want to expedite passing a bill that will bring back 100% bonus depreciation and qualified business income. Both of these do affect real estate investors, right? And it could potentially also be retroactive, right? So they could bring it back where they could say that 2024 and 2023, you still get to benefit from 100% bonus depreciation. We'll know more with time, but this is definitely on the agenda. The tax incentives per se are going to stimulate the economy. So definitely very pro growth. And more exciting for real estate investors and Trump's policy is the tax incentives, the tariffs, all of that is very pro-inflationary overall. And what that typically does is that it's likely going to cause cap rate compression. And I have a slide later on when I talk in detail about that. But what that means is that, it's going to move the multifamily or real estate market from the slump it's in to where people are willing to pay more for the same asset, right? So it's going to boost asset prices. The interest rate drop is going to help with that also. But, what this administration is hoping to accomplish is also going to cause cap rate compression, which means it's going to boost asset values for real estate. And then definitely industrial multifamily sectors will see a boost in demand. The second part of that is the deregulatory agenda. How is that going to affect real estate investors? I'm going to talk also about oil, right? Because there is going to be an oil boom. There is going to be increased fracking. This is going to really help boost real estate values in the Permian Basin in Texas, especially a market like Houston. And so that's something to keep in the back of your mind as you're thinking about what are things going to look like for the next few years. In terms of project timelines, it is going to cause acceleration. There are a few other things in their policy that could kind of contradict that. And so, like increasing construction cost and other things. But that being said, there will be a reduction in compliance costs. So that there may be a boost in construction starts for real estate. So it's really going to help developers and both for real estate and oil. Okay, trade policy, tariff overhaul. Trump has been talking about this a lot, and he wants to increase tariff preferentially also, right? So definitely increase tariff on China more so than others. But what that is going to do is it is going to, and like I said, so there's going to be mixed impact, but what we're looking at is what is the overall impact, right? So that is going to increase potentially renovation costs, construction costs. Whenever construction costs for new builds go up, it's also going to elevate the cost of existing assets, right? And so that is very inflationary in nature, which per se is good for real estate investors because in an inflationary environment, rents go up, asset values go up. And so that is definitely going to boost returns for real estate investors. Again, now this could cause potential delays in development timelines. So again, there is, it could play out either way, but there will definitely be a boost for domestic manufacturing. And so places like Houston that have a heavy manufacturing base are going to do really well. There will also be a surge in demand for industrial and warehouse spaces. So industrial per se, even through the pandemic, did really, really well as an asset class. And so industrial manufacturing, warehouse space, and multifamily, all of those are really going to benefit. Okay. Infrastructure spending is going to increase, which means more infrastructure jobs. And again, like I said, Phoenix, Indiana, Houston, any place that has a lot of energy jobs and manufacturing jobs is going to benefit both from real estate and from population growth. So lots of logistics and industrial job opportunities are going to open up. That needs to be factored in as you're picking markets. But what I will also, and I have some slides on the back end, honestly, and what has happened since the pandemic is the markets that saw a lot of migration during the pandemic also got hit with a lot of supply, right? And so rent growth has been more stagnant over there. But that being said, over the long term, those are the very same markets that are poised for more growth over the next 5 to 10 years. And so the fundamentals essentially stay the same, really don't shift as much, right? And so even when we talk about all of these changes, it still boils down to investing in those fundamentally strong markets. And I have more slides on the back end to talk about that. Now, this is something that, interestingly, has already affected, financing as far as multifamily and real estate goes. And so all of you have seen this also in terms of mortgage rates, right? And so Treasury yields jumped 50 basis points in 28 days, although the Fed is cutting rates. So for new development, anything that's based on short-term interest rates, right? New development, variable rate debt is being affected favorably, and anything that's based on longer term debt, so fixed debt in the commercial space or with conventional mortgages, what you're seeing as you're buying a primary home or you're trying to buy an investment property with a 30-year fixed loan, right? You've seen a jump in yields. And so therefore a jump in rates. And part of that is because of the anticipation of higher inflation due to the tax cuts and the Trump administration's tariff and trade policies. But that being said, this administration is very likely going to pressure to maintain interest rates low. The Fed also lowers interest rates based on actual inflation data, not on speculation and policy changes. And so these are the forward-looking curves. We are expecting more rate cuts, and although the anticipation is mixed, if the Fed is going to base its rate cuts on actual inflation data, and we are likely going to see a drop in the Fed fund rate moving forward. Now, the 10-year U.S. Treasury rates going up to 4.4%, that is causing financing constraints, not just for people in the commercial space looking to even as we're looking to acquire these larger multifamily assets. It's the same thing is also affecting home buyers and smaller investors, and it in a sense lowers housing affordability. We're at a point where we're seeing the largest gap in affordability, and that gap isn't shortening, which just means that it still drives rental demand, right? So as a real estate investor, that's something you're looking at. If housing affordability, the gap is so large where it makes so much more sense to rent, it is still going to push people towards renting, which maintains strong demand. And that's what you need to look at. Okay. And so the bottom line is this, right? We always control what we can control, and our decisions have to be based on fundamentals, which is why the second half of this talk, we're going to talk about overall economy, how things have shifted since our last conversation, last quarter, but essentially what the forecast is looking like. And we're going to look at multifamily fundamentals, and that's what's going to drive our decisions, right? And end of the day, what I like to say is it's almost like when you invest in the stock market, right? Dollar cost averaging. You're getting in at different parts of the cycle, right? And the long-term goal is always to really run the numbers, do your own due diligence. And most importantly, it is going to be to know where you want your asset allocation to move towards, right? And so if you're today not entirely in stocks and bonds, and you have a goal of getting 30% of your portfolio into real estate, that is your goal, and that's what drives your decisions. So stay the course with asset allocation. That's just how I look at it, and that's what I highly recommend. Okay. Now, that being said, let's move on to macroeconomic updates, multifamily updates. What I did is I kind of summarized everything up front, and then we'll take a quick peek at this. And then what we're going to do is take a look at more detailed graphs and try to understand what numbers look like, put things in perspective. The macroeconomic data is mixed. So again, we've had another quarter where we had strong growth, GDP growth of 2.8%, which is positive, right? And so we never really we had 2 quarters, I believe it was last year, where GDP was negative for 2 quarters consecutively. But since then, it's been positive, right? So that is good. Again, like all of you know, the Fed lowered interest rates by 0.5%. The anticipation was maybe 0.25. So they did have a major cut in September. And we are anticipating more interest rate cuts, and that is going to stimulate the economy. So that's favorable for the economy. It's also favorable for real estate, especially commercial real estate, because as interest rates drop, asset values will go up, right? So property prices will go up because people have more purchasing power. And so that is great for real estate investors. Now, the Fed has also implied that they may not lower rates as aggressively as they anticipated. But that being said, we still, that is already baked into the projections for forward-looking SOFR curves. It's baked into the projections as we underwrite. And, even given that we are anticipating rate cuts before the end of the year and then going into next year. Inflation. Inflation ticked up to 2.6%. So it went up from 2.4 in October, in September to 2.6 in October. So minor shifts, definitely not moving in the direction, that the Fed has a mandate to maintain it close to 2%. That being said, historically, inflation is between 3 to 4%. And so it is what it is, but those are the numbers. Unemployment rate dropped, which is good again, but small minor fluctuation. So really nothing major happening over there. The yield curve, I think, is the one place where there's been a major shift, and a lot of that is tied to the Fed lowering interest rates. And so the yield curve inversion is an indication of a recession in the near future. The yield curve after many months is finally uninverting, and so that's actually positive, right? And I will talk more about that later. So potentially a very mild, soft, maybe recession in mid 2025 is potentially what people are looking at. Because for the longest time we were debating whether we're going to have a hard landing and really bad recession, and so maybe a softish landing mid 2025. Just the yield curve is also uninverting at this point, which is great. Okay, multifamily fundamentals are strong. That's stayed strong. There's been very healthy absorption. I think the biggest concern was supply hitting a lot of markets in the Sun Belt, and the demand has been great through Q3, and so occupancy really hasn't dropped that much. Rents are actually beginning to grow positively after many months of staying plateaued or being negative, and the year-on-year rent growth is 0.9% nationally, which is great. Occupancy is also 94.8%. That's actually, guys, that's very, very strong, because mid-90s is strong occupancy. And anytime we're in a recession or at the bottom of the market cycle, which is where we are now, which is really hard to see if you're only looking at single family pricing, but multifamily pricing fell by 20 to 30% from its peak in March 2022. And so being at 94.8 occupancy at this part of the market cycles actually talks about very strong absorption, which means the demand is really good despite supply hitting markets, right? And so again, that is just proves the strength in the in multifamily fundamentals, and construction starts have been slowing, and so we are expecting strong rental growth and occupancy in 26 and 27. That being said, long term, we are in a scenario where there is supply shortage in the United States, and that's going to last at least a decade. And that means that home values and rent growth will continue, right? So again, strong fundamentals. We did see some distress showing up. A lot of that was in assets that were acquired between 21 and 2022 with short-term variable floating rate debt. But again, not to the extent that was expected, because a lot of loan modifications happened, and people are holding on and waiting for the upswing in the market. Now, I've been talking about this for a while now, and the question always was, where are we on the economic clock, right? Are we in economic winter? Are we at the bottom? Are we trending upwards? And we always said that we'll know when we're trending upwards when interest rates start cutting, right? Rent growth starts happening, and there is reversal of yield curve inversion, and we're seeing all of that, right? So now we know, based on the data, that we're on the upward trend, and I think that's really important for real estate investors. So let's talk about how a lot of that has shifted. How do we, in favor of us now trending back upwards as far as that economic clock is concerned. All of you remember this. This is when we were at the peak, 9% inflation. Inflation has gone down, and again, it snuck up a little bit, but really nothing major per se that may again may lower how aggressive the Fed is in cutting rates, but hopefully not significantly. Inflation is closer to where the Fed wants it to be, which is at its 2% mandate. Interest rates again have started dropping. Again, telling us that we're back on that, on the upward curve over there as far as the economic clock goes. The Fed fund rate went from 5.33% in August to 4.6%, and then we are anticipating more cuts before the end of the year. 10-year Treasury, I spoke about this. It ticked up from 3.6% to 4.4%. And a lot of that has been in anticipation of inflationary policies and, pro-inflation environment, which benefits real estate investors, but when you're talking about longer term debt, it needs to factor in where we're going to be, years from now. And so we did see this upward trend. And like I said, this is affecting housing affordability. It's also affecting financing for real estate investors. And so we're fortunate that we were able to pivot. It may make it a little harder to find and really have deals pencil out moving forward. But again, when deals do pencil out, they are going to be very conservative, and those numbers need to make sense. And that being said, it also affects housing affordability, which means as real estate investors, more people are going to be willing to rent than buy at this point. And so it supports strong rental demand and growth. Okay. I put this in here because again, it always, when you're an investor, it always feels like interest rates are crazy high, and how are the numbers ever going to make sense? But this chart, and I always say, when in doubt, zoom out. And I guess I just saw that this was a quote, and I didn't actually coin it. But interest rates this is basically, we're at very close to where interest rates historically have been in this country, right? And in every environment, there is a way to make the numbers make sense, and which is what we're doing in multifamily when we're going in, getting these projects where we've done loan assumptions, we're reducing property taxes, and that's boosting NOI. And so many ways to really, but sometimes you need to get creative, but there are ways to make the numbers make sense. Okay. Again, like I said, GDP, positive GDP, again, 2.8% growth in the last quarter. The yield curve inversion, if you can see, this is the longest time since, I think it was since the 1970s, right? That we've had, we've been in an environment where the yield curve was inverted for so long. And that just means that shorter term debt had higher yield than long-term debt, right? And we're at the point where this is inverting, because now we're at the point where the Fed fund rate is 4.6 and the 10-year Treasury is at 4.4%, right? And so again, if this is an indication of recession in the near future, potentially, because it's uninverting at this point, potentially a very, very soft landing in 2025. That's all we're looking at, right? If we're to believe the data, and that's what the data says. The interpretation of the data, let me correct myself. Okay, unemployment, there is job growth acceleration. So we're seeing those numbers drop. And then again, like I said, sometimes it's really important to zoom out. And so I switched the slide over here. But if you remember, if you look at this, we're, based on historical numbers, we're really not in a bad scenario as far as unemployment goes. And I think that's what you need to keep in the back of your mind, as opposed to just listening to clickbait where everyone's talking about very high unemployment numbers, but the data doesn't really support that. Okay, so historically speaking, we're actually in a very strong position. Okay, same thing. This again points to us moving in the right direction. We've hit the bottom, we're moving upwards because we are seeing positive rent growth after several months. And so you can see that. And this is across the nation, right? There is positive year-on-year rent growth, 0.9%. So that's, again, very favorable after months of plateauing and maybe seeing negative growth. And this is also very regional. We'll talk a little bit more about which markets are really being hit by supply and why rents aren't growing. But nationally speaking, rents are trended back upwards, which is positive, which means, again, it's an indicator that we are moving upwards as far as the economic cycle goes. Okay, so that being said, we are still, at a time where housing affordability, the gap is huge between really what you need to pay if you want to own versus renting, right? And that hasn't really shifted, and the treasury rate going up isn't really helping, right? So we're still in that environment, still have that huge gap between renting versus owning. And again, home sales is again is pretty low, and that has to do with interest rates being high and home prices, especially with single family homes. Home prices didn't really drop. I mean, we went through the equivalent of a recession for multifamily. Saw multifamily prices drop 20 to 30%, but not really, we didn't really see that in the single family space. And it's because a lot of people were really locked into excellent interest rates and they just really didn't want to sell, right? So not a lot of transaction volume, which kept prices up. Now, with interest rates dropping, we do anticipate prices to start going up both in single family and multifamily. Something to keep in the back of your mind. Okay, construction starts, they did take a dive, which is good for for rent growth and occupancy numbers, right? So that is favorable. And we did see very, very healthy absorption in Q2 and Q3, which is, which we're seeing because we're seeing positive rent growth, right? And so, although we've had a ton of supply hitting most markets, the positive is that construction starts are dropping, and in large part that is because of the cost of construction and because of interest rates being where they are. Okay, moving on, guys. Now, I'm going to try to get through this really quickly, but the important thing to note is that for the years moving forward, right? And this is multifamily, throughout the country. We do expect positive rent growth, very healthy numbers, and occupancy to stay pretty healthy also. And that's what I want you to take away from this, right? So that is the forecast for the next few years. Now, again, a lot of this is very market driven, right? And so there are the high growth markets like Dallas, Phoenix, Austin, and especially Phoenix and Austin, to some extent Dallas. And again, this is very submarket driven, right? Because we saw in Ellis County, which is where the townhomes at Bluebonnet is, supply is restricted because the county is very intentional about new developments, right? So again, if you look at the larger markets, there is a difference between markets, but then it's also very important to look at that submarket. And you can see that by looking at the current occupancy numbers and what that looks like, right? But the markets that had the highest growth also was hit by high supply. The positive is that there's been great absorption, right? So in most of those markets, most of these high growth markets, occupancy didn't drop significantly. Right. And so, and even if you are seeing stalled rent growth, and you've seen that for a few years, it will recover, especially with construction starts dropping, but also because of healthy absorption. And that's true for Dallas, Phoenix, Austin, Atlanta, Houston. But these are also the metros that are going to have continued population growth. And I have some data to back that up. And so, considering that these are the areas that have, have had high growth, also was hit with supply, they're also the locations that have sustained population growth, that it becomes important to factor that in, right? And so there has been migration of people because of work from home, and that is something that is here to stay. And so the markets in the Sun Belts still are, poised for good rental growth and occupancy in coming years, and that's because of in-migration, right? That's because of the forecast for population growth. So, historically, between 2022 and 2023, Texas, Florida, Georgia, they did see the largest population growth. That's historically speaking, and you can see that even if you go to U-Haul, and you can check this out. Every year they publish where they've seen the most, in migration. Texas, Florida, North Carolina, South Carolina. These are where they've seen the most, most people moving to. But if you look at forward-looking curves, right, where do we expect to see between 2023 and 27 young adult population growth, right, relative to inventory? That's also going to be those markets in the southern states and the western states, right? And so I think that the important point is those high growth markets did see supply, and so rent growth did stall, but they are also poised to see the most growth, especially with this presidency, because of oil and manufacturing and all of that, and those states being pro-business. It's important to keep that in the back of your mind as you're picking markets to invest in. Okay, so like I said, we hit the bottom, and all the data points that were now trended back upwards. Multifamily fundamentals are still strong. We do anticipate a soft landing potentially next year, but we are acquiring assets at at very good basis, right? So highly discounted assets. As rates fall, prices will increase. We still have this huge gap between renting versus buying, and so renting is still significantly cheaper. We are in an environment from a long-term perspective, right? For the next decade, we are in an environment where we have supply-demand mismatch. So we do have a lot of demand, and supply is not keeping up with that demand per se. Right. And then we have the new administration, which has policy that promotes inflation. Inflation is a real estate investor's friend. And so, as a real estate investor, that's not something we need to worry about, because when that happens, rents go up, property prices go up, and that does benefit us. And so, like I said, this is the time, and with so much uncertainty, understandably, it's a time where, psychologically, it may not feel like the best time to invest, but it is the time of maximum opportunity. Now, I don't recommend timing the market, but I do think it's important to look into the data and really lean into the data, right? Because when you're buying assets, discounted assets, like I mentioned, just because of the lending environment we're in, we were able to negotiate a further discount on an asset on Vizcaya, Cortland Vizcaya, right? And so when we're buying discounted assets, that's what allows us to get those outsized returns, right? And so that's the environment we're in. And so run the numbers, do your due diligence, but lean into it. Okay. And it's important, like Warren Buffett says, be fearful when others are greedy and greedy when others are fearful. Okay. So this zooming out part, I just want to show you what historically, right? If you look at multiple cycles historically, what happens to rents and asset values during times of recession. If you look here, this is the 07-08 period, and this is what happened to rents, right? Rents plateaued for a little bit and they kept trending back up, right? So rents really don't drop. And this is true if you are investing passively, actively, right? This is the important thing to remember. Rents don't drop drastically. They plateau like they did during this, during between 2022 to 2024 also. And then they keep going up, right? That's what happens to rents. Asset values did drop significantly during 07 and 08 for both single family and multifamily. This time around, asset values dropped significantly for multifamily. You don't really see that in single family, but remember that it starts trending back upwards, right? So the trend is always upwards with those bumps. And for you as real estate investors, the key here is as long as you have the ability to hold on to an asset, right? And so your revenue is not going to drop significantly, right? And the revenue is always going to plateau. It can drop a little bit. At most, it drops 10%. That's what happened in 07, 08. Revenue dropped 10%, right? Sorry, if you could just mute yourself. Adrian, can you assist, please? Okay. But asset values, they drop and they come back up. And so what defines your success during these periods is always going to be your ability to hold on to an asset. And so that brings me back to, okay, so how are you going to be looking at real estate? It really hasn't changed much. Some things are highlighted more than others at different points in the cycle, but you're still always looking at strong markets, because that means that you're going to have good rent growth, right? And we talked about that a little bit. You're going to look at assets that have positive cash flow, which is why in say Blue Bonnet, we have an average cash flow, I believe, of 5.5 to 6%. In Cortland Vizcaya, we have average cash flow close to 7%, right? And it's cash flow positive day one. Both of those assets are about 5% cash flow day one. That's something you look at, because that is cash flow going in without really assumptions going up and you executing your business plan. That's how you're acquiring the asset. That becomes really important. It becomes important to really get discounted assets, because it's giving you, significantly higher returns on the back end. And then the ability to hold, right? That's, if you're taking away something from this, it is, when you're doing your due diligence, do we have the ability to hold on to the deals? And that's where debt comes in. And we've always, been looking at flexible holding options with really conservative debt. And that's what you should be doing also, right? And then be very, very conservative in your assumptions. How much do I expect rents to grow, rent growth to, rents to grow in the Houston submarket, West Houston, Katy submarket, where Cortland Vizcaya is? The forecast is for rents to go up 6%, right, in 2026, just based on supply demand. That's not what we're underwriting for. We're underwriting for a 3% rent growth, right? So be very conservative in your assumptions as you're navigating these markets, and you will do just fine. Okay, we're done with the market updates. We're done talking about policy changes and how that can affect real estate investors. I'm going to really quickly deep dive into the assets we currently own. This way, I mean, and we like doing this because we're just going to highlight everything that's been happening with these assets, and then we'll have tons of time for Q&A. So let's get started. Okay, Bronte portfolio in Mesa, Arizona. That was the first asset we acquired through GW Capital. It was an off-market acquisition. Like I said, March 2022 was the peak of the market, and then we acquired this at a discount in July, but asset values did drop significantly since then. That being said, operationally, the asset has been doing phenomenally, right? Operationally, we've seen strong revenue growth of 31% since acquisition. And then occupancy has exceeded 97%. Again, a lot of this has to do with property management changes that we made. So they're doing a phenomenal job. Delinquency, a 76% decrease, and zero delinquencies across Mesa East and West for the month of September, which is phenomenal. Our renovation costs also, so we are over $1.5 million less than where we expected to be in terms of renovation costs for the renovations that we've done. Now, that being said, we acquired the asset somewhere here. I hope you can see my pointer, slightly below the peak of the market, but the market did drop significantly since then. Interest rates went up significantly. No one anticipated rate hikes to go that quickly. With all of that happening, and then Phoenix did get hit with oversupply, right? And so that it had stalled rent growth for quite some time, the market per se, right? With our rehabs, we were able to bump up rents and increase revenue. But that being said, the overall market did see softening of rents, right? And so we had to make the tough decision where a lot of our general partners, all of our general partners in the deal, apart from us, went in and did a capital call to have their investors put in more capital. GW Capital, I put in my personal money into the deal as a member loan, 8% interest going to our investors. That gets accrued, that gets paid out to our investors when we sell, but it is my personal capital in there. And with that, we've been able to stabilize the asset. We've successfully negotiated a loan modification, which gives us the ability to refinance in 25, 26 as the interest rate environment improves, as asset values start going up, and then potentially having a 2028 exit. Now, distributions have been paused. That is the right decision for this asset at this time. RSN and GW Capital, we haven't taken any asset management or construction management fees. As general partners, we have close to $2 million of our own capital in the deal. The deal is operationally doing phenomenally well. I just showed you the numbers, but distributions will be held till we can refinance the asset, right? And so all we're doing at this point is holding and waiting for that time. Okay, Pelham Place in Greenville, South Carolina. This asset, those of you who are in there, hopefully you've seen distributions have been restarted. Again, this has also operationally done really, really well. We got this asset at a very conservative fixed interest rate debt, 65% loan to value. Again, has $1 million of GP equity in the deal. We completed 2 years of ownership for Greenville. We saw really strong NOI growth, 48% NOI growth over the last 2 years, really strong rental income growth. So very, very, actually exceeded expectations. And if you look at in the emails that you received, you should have our performance report in there, and you can go in and take a look at these numbers. But occupancy stayed pretty stable. Now the submarket occupancy over here is 89%, right? So we're still doing better than the submarket. Delinquency has been reduced by 94%. So again, this is great. Our goal is to keep increasing occupancy and being really intentional about how we're rehabbing. But you can see that with the rehabs we've done, really been able to boost up rents. Rents have gone up about 33% since acquisition, and a lot of that has been related to rehabs and really doing turns and upgrading the units. This is an asset where, and I bring this up because I know, and some of you may have seen this before, but for a lot of you who are trying to understand how value add works in multifamily, I think this is a great example. And so we, executed a water conservation plan on this asset. And with that, we have an annual savings of $45,000, right? And so how does that translate to whenever we either reduce expenses or increase income, right? A $45,000 increase in your net operating income translates to close to $1 million in the assets value going up. And that's how we add value with commercial real estate, multifamily. And that's why, so in Cortland, Vizcaya, when we're dropping property taxes from $1 million to $150,000 going in, that gap increases our net operating income by 37%, right? That's how we're adding value to the asset. Same thing. We also had a tax abatement plan on this asset. And what it does is that it significantly reduced the tax bill, actually takes the tax bill down significantly, but there's also a small fee that you pay for it. And so that's a 61% reduction in property taxes for that asset, all of which really helps to boost up the asset value. Same thing here, renovations were significantly under budget. And so the goal has been to really be intentional about costs. And I think over here, we're about 45% less than where we expected to be. So a savings of close to $2.5 million. Okay. And so, like I said, the goal is to boost NOI further. A lot of that is going to be geared towards improving occupancy, and then strategically refinance in 2025. We've also reduced the fee that we have to pay for the tax structure that we have in place, and that is also yielding an $82,000 annual saving. All of that, like I showed you, when we do that, we boost the asset value. So that's super beneficial. And distributions have restarted for B and C. And so if you, for any reason, haven't received your distributions, so Class A, B, and C are all getting pro forma distributions at this point, please reach out to us if for any reason it hasn't hit your bank account. This asset, again, I walked this asset last year, I believe, and they're doing a great job with rehabs and really staging with the model units and really improving the feel of the asset. Okay. Elevated Eagles Landing. This is the first asset we acquired in Atlanta. 10-year agency debt, very tight rate cap, 06 asset, so newer asset. And again, all of this data is there in your in the PDF if you're looking for more detailed information. But stable occupancy, delinquency has been reduced by about 63% since acquisition. And really a lot of the renovations are in full swing at this point. When we do rehabs, and even if you're doing a rehab, right? If you're doing this and you're doing the BRRRR strategy, trying to rehab a single family home that you own, what you want to look at is how much are you putting into the rehab? And in terms of boosting rents, right? After you've boosted rents, what is your annualized return, right? So if I'm increasing my rents if I'm putting in, and so for this asset, we're putting in $8,000 per unit as opposed to what we originally projected, close to $12,000. So a lower rehab cost, and we're getting, excuse me, close to $150 in rental bump, which translates to like a over 20% annualized return, right? Which means that in less than 5 years, we're able to recoup the cost of rehab. And that's what you want to look at. Typically, you want this number to be over 15%. So anytime we say, hey, we're doing the rehab and we're getting greater than 22% returns, that is a good number. Okay. Okay, and full distributions were paid out. For Eagles Landing, just pictures of the rehab units. So this is Elevate Green. Is again it's a sister property to Elevate Eagles Landing, 05 build, institutional class asset. This one had 3.6% fixed interest rate. This was a loan assumption. And so we will be refining this asset, I believe, in 2026. And so this was an exciting business plan because of the loan assumption, the really low interest rate. And at that time, if we had gotten new debt, it probably would have been a few points, at least like closer to 5.6% at that time. So this was very strategic acquisition. NOI, again, operationally is doing phenomenally. NOI has gone up 54% year over year. So the numbers are very, very strong for this asset. And that's despite delinquency. We're still, really working on getting delinquency where it needs to be. But occupancy has gone back up to 92%. So those are healthy numbers. Rehab is underway. Exterior renovations are mostly done. And I walked the property earlier this year. And the ROI over here in terms of what we're putting in and the rent bumps we're getting is at 15% annually, which is where we want to be. All right. Now, with this asset did have a fire at the beginning of 2024, and 8 units are, cannot be rented at this time. Now, full reimbursement is expected, except for the deductible amount. And we do anticipate that by Q1 2025, we will have distributions restarted. So what we had to do is Class A, and this is what happens with those Class A cash flow positions, right? They get a preferential position in the capital stack, so they get paid out. And not every deal is structured this way, but this is similar to, I would say, Bluebonnet, right? So they get paid, full distributions are going out to Class A, but anyone in Class B and C, distributions have been reduced to 25% because we're waiting for this to really play out and for us to be able to restart distributions. And so we're hoping that by Q1 2025, we will be able to restart distributions for Class B and C and get them to full distributions. We may be able to make people whole for the time frame where they did not get distributions. It's going to depend on where we land in terms of how much we get from the insurance company and how much we actually put in there. So if there's a difference, we may be able to give people the accrued distributions up front, or else it'll be accrued and you'll get it on the back end, right? And so we'll have more clarity towards the end of the year going into Q1. Okay. Elevate Park 33. This is, I believe, the first Core Plus asset. So this is a 2018 build, right? This is very similar to, I would say, Bluebonnet, which is like a newer acquisition, right? And so this was, again, a great debt, 7-year loan assumption at 3%, similar to McDonough, but so very low risk property, and revenue has gone up 9%, since acquisition. And occupancy is at 97%. So it's really, really high, even for that submarket. And so that's great. Delinquencies dropped by about 58%. So that's great. Full distributions have been sent out. Now, Stewart's Mill, going forward, all these assets have been held for a year or less than a year. And so that's the period where stabilization happens in multifamily, especially for value add. Now, Stewart's Mill is like a traditional bread and butter value add asset, 1988 asset. We got it at a 17% discount with fixed agency debt, 6%. And so with these assets, it takes a while for stabilization because we're turning the tenant base, getting in more better quality tenants, and reducing delinquency, right? And so this asset, again, strong location. The rents are above submarket average by 6%, which means we can be competitive, but it's really stabilizing at this point. And you can see that with occupancy and delinquency. So it's in that phase where we're really turning over the tenant base. And so over time, especially given that age of the asset, right? This is your traditional value add asset, unlike some of the other assets where you've seen those are core plus assets, newer builds, very different tenant base. So the goal is to really boost occupancy, reduce delinquency, and then start the rehab. The renovation program is underway, and start rehabbing it and then bumping up rents. Again, we have to be strategic about that. But now with most markets starting to see rent growth, it's a great time for us to go ahead and really amp up our renovation. Now, full distributions have gone out. If you have any questions, please reach out to Adrian. Dawson Forest is a 1998 asset. Again, institutional quality. It's in the Atlanta-Alpharetta corridor. Now, what was really nice about this is that that's submarket. And so, like I said, the same thing with Bluebonnet, right? Some submarkets really limit supply. There's not a lot of inventory. And so that allows these assets to have higher occupancy and really command higher rents also because of that supply demand mismatch. And so, it's again in a great location with a lot of high end retail because it's right next to the North Georgia Premium Outlets. There's this submarket, right? And so even within the larger MSA, this submarket is one of the fastest growing counties in Georgia, and great school districts. And so you will see, again, occupancy is 92%. It's pretty stable. Delinquencies dropped by 86% since acquisition. So that's great. Full distributions have been paid out. There's a 3.4% increase in rents, and this may not seem like a lot, but knowing the market that we have been in, this is, this again goes to show you how there is a, just because of supply in that submarket, it's maintaining healthy rent growth. Okay. And we're also, again, because it hasn't been a full year since acquisition, we're still catching up to market rent. So we're waiting for a lot of the tenants for their leases to expire or for them to move out before we can bump rent out. So a lot of that loss to lease is still is yet to be captured, right? And so we're in the phase where we're working on rebranding, renovations, and really working on boosting occupancy also. Okay. Villas at Sundance. Now this, we finished our first full quarter, so not a lot to report. Also an institutional quality asset. We love the location. It's in the Austin San Antonio hypergrowth corridor. It's again a Class A property, one of our newer properties, and rents are about 10% above market averages. Delinquencies dropped since acquisition, and the goal is just to stabilize the asset at this point. Full distributions are going out. Cortland Med Center is our most recent close, and so just have a few updates about it. This is like a sister property to Cortland Vizcaya. Cortland Vizcaya is just a better submarket. It's in West Houston, Katy ISD, but otherwise the business plan is very, very similar, same sellers. So again, here we had a 6% fixed interest rate debt on this property. It's a Class A property, the same 85% tax exemption business plan over here. And this one, the sellers had already put in $7 million to rehab it. We got it at a $2 million discount. All the units are rehabbed to platinum finishes, and it's in the Med Center submarket, which means a lot of students over there. Great tenant base. I was over there, and same thing. The goal is to maintain strong occupancy of 95.6%. That's where it is at. It's been at 95% for the last few years. And I was there, I was talking to the property manager, and I asked her about how the re-tenanting was going, because again, it's like the same affordable housing plan. They don't even notice it. It's because 50% of the units are at market rent, 30% need to be for tenants who are whose income is at 80% of average median household income or lower, and that is already baked in there. So there's just very little re-tenanting that needs to happen, and nobody even notices that it's happening. It just happens very organically. Okay, so that brings us back to the end of the report. I'm super excited to dive into Q&A. But just again, for those of you who are looking for an opportunity, really looking to tap into 60% bonus depreciation, and really looking for a lower risk asset with that higher value add return, Cortland Vizcaya is an excellent asset, potentially on a wait list at this point. And so it's on a first funded, first served basis. And so if you go on to gwcapital.com/Houston2, submit the soft commit form, puts you on the wait list, and then we'll reach out to you. And then as long as space is available, you have the ability to get in. The funding deadline is December 1st to get all funds in. And so, like I said, potentially projected 20 to 22% average annualized return, and our investors do get higher preferred returns. Okay, awesome. That's it. I'm very excited about what the next few years bring for real estate investors. Like I said, the data, and I talked about the economic clock and the data showing that we're finally trending back upwards. We're excited about GW Capital Fund 1 and the ability to really provide our investors with diversification, a better experience, and better terms. And so if you have any questions, guys, book a call with us. You can scan the QR code, or you can go to gwcapital.com and book a call with us over there. Before I wrap up, we do have our next in-person meetup in West Palm Beach. I'll be there for Date with Destiny, Tony Robbins event. And so if there's any of you who are going to be at the event or who live close by, I'd love to meet. And hopefully Indra can make it, and she'll be there with us. We'd love to meet all of you. It's generationalwealthmd.com/RSVP in lowercase. If you go there, you can fill out the form RSVP, and love to see all of you in person. Again, that's what I think keeps me going, and I think it's great for all of you to connect with investors in your community and really lean into that community, and yeah, definitely RSVP. I'd love to see all of you in person. Okay, Adrian, if you could do me a favor and drop in any questions we have from other platforms in here, I appreciate it. Hey, Geeta, Neckpen, yes. Ravi is from Southern California, my neck of the woods. Rushim, okay. Hey, Rushim, hopefully you got some information about the deal, but if you want to book a call with the team, Adrian, can you please drop, it's right there. It's gwcapital.com/ Zoom with GW Capital team, but the link is in the chat if you want to just book a call with us and be more than happy to deep dive into that. Like I said, I think it's time sensitive. So if you don't find anything on our calendar for tomorrow or Sunday, just shoot us an email and I'll see if I can, if one of us can hop on a call with you. Thank you, Indra. Nice to see you on here. Hey, Shri. Um, so your question is, I was wondering if there's a mismatch between demand and supply. Why is it a buyer's market? I'm wondering if you're referring to a specific market, Shri. If you want to unmute and just give me clarity, that'd be helpful.
Yes, yeah.
Oh, hey.
If the supply is low, then it will be a seller's market, isn't it?
Correct. Did I say it will
No,
be a
no.
seller?
But when we are looking for a single family houses, it's a buyer's market. Buyers have the say.
That's
What?
because, yeah, because, I think it's all relative, right? So again, it depends on the submarket. But if you look at, say, 2 years ago when transaction volumes were really restricted and when interest rates were super low, there weren't a lot of, there was, for each deal, there were 10 buyers. So if you looked at 2022 and 2021, it was really, really hard because inventory was really low and interest rates were kind of low also. So there were like each deal had 10, 20 offers. So that's a seller's market where the seller can demand anything. Relatively speaking, now there are, we're more of a buyer's market, especially in the single family space, right? Same thing with multifamily. We're getting discounts because interest rates are so high that property prices are lower, it's discounted. So it's a different environment because not everybody is able to take the capital to the table for down payments and manage those mortgage payments, right? So compared to say 21 and even 2020, I think the second half of 2020, 2021, that was when we were in a seller's market. No one was on the sidelines. Everyone was jumping in. Even if the numbers didn't make sense, there were people who wanted to buy and there wasn't inventory. That was your typical seller's market. Right now, again, it's not like, I think if I look at the markets I've been exploring, you can't go in and demand ludicrous things. It's not like it's not your traditional buyer's market, but it's definitely more of a buyer's market than it was. There are discounts. In some markets, sellers are willing to pay for some closing costs. But that's because interest rates are so high and people are just trying to find ways to make the numbers make sense. And like I said, that housing affordability gap, people aren't able to afford the mortgage payments. So there isn't as much of a of a demand from the buyer's perspective. So it's relatively speaking, it's more of a buyer's market right now.
Okay.
Yeah. Okay. Yeah, I think Ravi, you were just chiming in. Yes, yes. And so absolutely right. So Ravi says, supply is still low, inventory is low, so it's unlikely to become a buyer's market anytime soon. You're not going to see that traditional buyer's market where there's a glut of inventory and people are just like, you can go and you can negotiate anything. We're likely not going to see that with this cycle, right? Which is what we saw in 07-08. We're likely not going to see that. This is as much of a buyer's market as it potentially is going to get. Because as rates start dropping, more people are going to, want to start acquiring assets, and then the tax benefits start coming in. It's just going to become more of a seller's market. And this is as much of a buyer's market as we get to see in this economic cycle. Hey, Ravan, will the PowerPoint be shared? So you will have, typically don't share the slide deck, but you will have access to the replay, and we'll be sending that out. Adrian, if you want to can you drop the replay page link on here? It's going to be on there within a few hours. Adrian's always great about taking care of that as soon as possible. And we'll also send out emails with the replay. You can catch the replay on our YouTube channel and on Facebook. So, perfect. Thank you, Indra, for answering that. So you'll be able to access it. Okay. Hey, Nekpen, you can unmute yourself if you need to, because I know you said you have a question. And guys,
Yes.
yeah. Hey, okay, and just raise your hand, guys. Hey, Abhishek, nice to see you on here. Anyone who wants to ask a question, also feel free to unmute yourself, and then I'll take the questions. Hey, how are you doing?
Hi, Param. I'm doing well. Thank you so much for the overview. I think that something that I've been kind of stewing on, I would love your perspective on this. You just mentioned how so many homeowners are actually underwater. I think something like 40% of homeowners are living in homes, at least in Texas, that are worth less than what they owe on the note. There's been a lot of delinquency even on the mortgage side. And there's it sounds like there's just been delinquency in some of the properties you're managing on the renter side as well. So I'm curious. And I also recently heard that like something like 30% of Americans have taken out a personal loan in the last 3 to 4 years just to curb the inflation and impact on personal consumer power. I'm curious, where do you see the market going with those statistics, right? Where affordability seems to be challenging for some people and renters having higher delinquency than historically estimated. Like, how does that impact ability to mark up rents or drive value with renovations? I would love to hear more.
Yeah, and so a lot of this is cyclical, right, Nick Penn? So typically when we're at the bottom of the cycle, like we are, that's when occupancy starts dropping, vacancy starts increasing, and delinquency kind of goes up. That being said, if you look at the unemployment data that we showed, right, it's not, we didn't see as much of a spike as we did maybe at other times. And so fundamentally, like even with occupancy, we aren't seeing, so the delinquency numbers you're seeing, and a lot of the assets we've been able to reduce it down significantly, just goes to say that a lot of that has to do with stabilization of the asset, because for most of our assets, delinquency, I mean, if we were, if we really were in a really, strong recession, we'd probably see those numbers significantly higher. So a lot of those assets, they're within the realm of normal. Now, the problem and the reason, so it has less to do with the economy, and it has to do more so with a lot of, trends that's shifted since the pandemic. Because in places like Texas and Atlanta, typically, if you had someone who was delinquent, you could move them out within a week, right? And that's how it used to be. Now, with the pandemic, there was this huge backlog. And it feels like in some submarkets, the culture also shifted where now, in South Carolina, North Carolina, it can take up to a month to evict someone, right, who isn't paying. It wasn't the case in Atlanta and Texas, but in some of those submarkets in Atlanta and Texas, we're now seeing where the county is pushing out eviction dates and the time it takes to evict someone. And that has been the reason why. And so you'll see like a lot of our assets delinquency is like phenomenal. And that just goes to show the strength of the economy, right? People aren't in a really bad situation per se as far as household formation and job losses, but it has more to do with like some submarkets. It's just hard to evict people who are delinquent just because the county is taking that much longer to be, so it's not as favorable as it used to be. And that shift, a big shift happened during the pandemic in, say, Georgia and Texas. And so again, very submarket driven, which is why some assets are doing phenomenally as far as delinquency, and some of them it's painful and it has to do not more so with the county than with property management. And so I'm pretty sure there was a second part to your question. What part did I not address?
No, I think I was just saying, like, to what degree are you thinking about where you're going to invest as it relates to the policies around delinquency or being able to reclaim your asset? That's really something I've been trying to decide.
Yeah. Great question. And so that's why I had this one slide where we talked about, and you'll hear a lot about this. And there are two camps, right? And so I think the thing is that data is data. There's always the interpretation of data, right? And so when you look at, and I can even pull that slide up, and it may be beneficial to do that. So let me just do that. Because, and that's specifically why I had that slide in there in terms of how do you pick your markets, because that's going to be a big question for a lot of people. And so, specifically this, right? And so you have the markets where, so there are 2 points, right? So you're looking at demand supply mismatch, but then there's also this other factor that I mentioned, which is a secondary factor where you're looking at how long is it taking to evict someone, right? So even though we're talking about states like Texas, Florida, and Georgia, which are technically landlord friendly, it shouldn't take you more than a week to evict someone. We're not talking about North Carolina or South Carolina. Traditionally, it takes longer in those states, right? We're not talking about California where it can take up to 3 to 4 months, right? We're talking about states where traditionally that shouldn't be an issue. So that's a second point, right? You have to do a little bit of digging to see how long it takes within that submarket now to get evictions done. And that's like it's a single data point, which I think is very beneficial. So that's one part of it. But when you're looking overall at like which states do I go into, which submarkets do I go into, traditionally, we looked at those high growth markets and said, oh, everyone's moving, especially during the pandemic, right? Everyone's moving to Texas, Georgia, Florida. That's a great market to invest in. Over the last year, you probably heard people say there's a ton of supply hitting those markets. And so that's going to dampen rent growth and it's going to affect occupancy. So are those still the right markets to go into? And there are two camps. Right now, Texas has also been hit with higher property taxes and higher insurance costs, right? So rents haven't grown because of supply glut, and now expenses are going up. And so you'll see a lot of people moving out of those markets for that very reason, right? And so the question is like, do we still look at those markets? And that's where there are two camps, and that's just why I say data is, it's based on your interpretation, but all forward-looking curves show that these are still the markets despite the high supply hitting them. And there's just been a very strong absorption. That's what we look at, right? What is absorption? What's in the supply pipeline? And then what's the population growth looking like? And is that really going to be able to absorb things? Or are we still going to see rent growth and occupancy growing? Those are the big things. And then where are we in terms of expenses, right? Because that's what happened with expenses in Texas, which makes it a little unaffordable. So those are the big things you're looking at. And our interpretation of the data is that these are still metros that are going to have the strongest growth, which is why I looked at that forward-looking curve, right? This is a forward-looking growth curve based on supply hitting the market, inventory growth, and on population growth, right? So these are still the areas that despite the high inventory, because of projected population growth, they're still going to do really well. And so which is why we're still focusing on those markets, right? And so you'll have, and it's, the trend, the work from home trend did not shift. These are still the markets, especially with the new administration. Like I said, oil jobs, manufacturing jobs, they're all going to go to those because those are the landlord and business friendly markets. They're still going to go there. So we still anticipate those to be the strongest markets to invest in. There is a second camp where they feel like, with expense growth, and there's a lag, right? So when inflation hit, there was tremendous rent growth and asset price increase in these markets, right? Because of demand supply mismatch. But then after a while, property taxes and insurance went up. And there was a lag. And so people got caught in that middle, got burnt, right? But again, we're looking at longer term data. So that being said, over the long term, yes, that lag did burn a lot of people. But that being said, over the long term, these are still very strong markets from a supply demand perspective. They will see good rent growth and occupancy over time. And I mean, we would still tend to focus on these markets. Now, there's a second camp who feels like secondary and tertiary markets will likely make more sense. And again, you have to do your own due diligence, and there's no one right answer. But this is the camp that this is how I interpret the data, and that's what I'm presenting. I hope that was helpful.
Yeah, very helpful. Thank you.
Okay, awesome. Okay, guys, I'm going to take a look and see if there are any other questions, and if anyone wants to raise their hand, more than happy to unmute and have a discussion. Hey, Abhishek. Okay, so it is going to be, so we have complete control over who we rent it to. About 50% of the units can be rented to anyone, irrespective of their income, right? So market rents, 30% has to be rented to households with income that is less than 80% of the average median household income for that submarket. And then an additional 20% has to be rented to households with income less than 60% of the average median income for that submarket. I hope that helps, Abhishek.
Yeah, that helps. Is that something will be rented to like people who are on those what do you call rent, some kind of
No,
reimbursement? I guess?
interestingly, because I know you do a lot of Section 8 also. Interestingly, I was at Cortland Med Center, and this is the exact question I was posing, right? And this is true for all the other assets that our partners have had the same structure on. This is probably the 13th asset or 12th asset that they're doing this. So the re-tenanting is really not that rigid, right? So what happens is you have 12 months to shift the tenant base, and probably 80% of the people are already where they need to be. So the 50% you don't have to worry about. The 30% where income needs to be, at or below 80% of average median income is already there because there are a lot of students over there, right? And so they already meet the criteria. So between the students and the current tenant base, there really isn't, maybe 5 to 10% of the tenants, when they leave, we'll have to get people who are below that income criteria, but everybody else is already meeting that criteria. So yeah, so it's not going to be, people, so it's very different from a Section 8 housing perspective.
Got you. Thank you.
Yeah. Hey, Meher. Yeah, resources to start investing in real estate. That's a great question. I'm trying to lean into. I have a few. Oh, thank you so much, Indra, for dropping that in there. That is a great guide for passive investing in real estate. I think some other books that I really liked along the way were Rich Dad Poor Dad and The Millionaire Real Estate Investor. I think that's more for when you want to buy your own properties. I think those would be great resources. We have a podcast, the Generational Wealth MD podcast, on Apple, Spotify, and you can pick a topic that makes sense to you. We do very generic, financial freedom. We talk very specifically real estate, direct ownership, passive investing. So I think that's a great resource. And then our blog is helpful too. And then those books I think are great starting points. Hey, Puvan, how are
Thank you,
you?
Param.
Sure. In the syndication, you have a tax write-off or only on passive income, not on W-2 income. Yes, you're absolutely right. So the 40K in passive losses. Also, but Puvan, you have a personal portfolio. So I'll explain that in depth so that a lot of you can apply it to your portfolio. So for every 100K invested, you expect to get about 40K in passive losses. Now, passive losses can only be used against passive income. It cannot be used against your W-2 income. But passive income includes your distributions from the syndication. So if you get over 5 years, 35,000 in distributions from syndications, if you didn't have the losses, in California, we have to pay 53% marginal taxes, right? So I'd be paying 53% in taxes. And so you don't see it on your bank account, but when you pay taxes on the back end, you're paying that, right? If I have a CD, like I think last year I paid $30,000 in interest income, income taxes, right? So we're paying that on the back end. So same thing would happen to your syndication investment distributions if you didn't have bonus depreciation. So you will use those losses against your distribution from the syndication. So all of that becomes tax-free. Now, if you have a short-term rental, right, and you're getting passive income, so the first year it may be active because you may materially participate. Second year, third year, when you have passive income, or if you have passive income from your other syndications or from other rental properties, all of that is passive income, and you can use these the losses right away to offset any passive income you have. So you can use it against all your passive income. Like some of our investors have $50,000 to $100,000 in passive income from syndications. You can use this against any of that. If you're exiting a syndication, you can use the passive losses against capital gains and depreciation recapture from any syndications you're exiting. So you can play with it within the passive bucket anywhere, but you can't use it against your W-2 income unless, and I think you were considering this, you or your spouse has real estate professional status, then you can use it against W-2 income.
Sure. So if my wife has real estate professional status,
This year, she has it this year, right?
yeah, she is likely trying to get it, and she
Yeah.
invests in your syndication. In
Then
that case, is it possible to count it like on a
yes.
W-2 income?
But there's only one more criteria to meet. So if she qualified as a real estate professional for 2024 and you invest in the syndication 100K, you get 40K in losses. She can use those. She can use that against your W-2 income if you also materially participate in your portfolio, which means she has to spend 500 hours managing your rental portfolio, which I think she will be because that's the criteria she's using to get a real estate professional. But that's just an independent criteria, so I want you to be intentional. As long as she's spending 500 hours on your real estate portfolio, then that she hits material participation, then you can use the grouping election and use the passive losses against your W-2 income.
Sure. Yeah, thanks for clarifying.
Yeah,
And
yeah,
even
absolutely.
the
I
gains.
forgot for a second that your wife was trying to get real estate professional. So then, yes, but as long as she hits material participation and real estate, which I think she will because that's how she's trying to get the real estate professional status hours, then you should be able to use it.
Sure.
Awesome.
Yeah, thank you.
Okay. Did you want to add on to that question, Puvan?
So even the capital gains from the stock sales, even they will be counted as a passive income, which can be possibly written off against the syndication depreciation losses. Is it correct?
So capital gains from stock sales is considered portfolio income. So it can't be, you can't use passive losses against portfolio income, but I'm not sure what happens when those losses become active. I'm not sure if because they're active, if they can be used against portfolio income. That I'm not 100, maybe ask your CPA, Pawan. That is a question that I don't know the answer to. I'm not 100% sure. Okay.
Thank you.
Hey Shri, yes, so it's on, perfect. I think Indra answered the question. It's on the cash flow portal. You have access to the link. Hey Lajide, yeah, there has been a major change, and sub markets are different than others. And he says that in Florida, he hasn't been able to evict a tenant after 6 months, and so that's which is why we're intentional about the sub markets we enter, and we want to make sure that that sub market, that county. Not submarket, I should say the county, right? The county policy, we just look to see, what is their lag period, and that's something we're very intentional about tracking. Um, hey Williams, the requirement for Dawson. Okay, yeah, I think Indra answered that. Okay, and then Poovan, I think I answered your question. Okay, yes, I answered your question and Abhishek's question. And then Mihir. Okay, Mihir says thank you. Any recommendations? Oh, I think yes, perfect. Indra has shared that. We should be good. Oh my God, guys, thank you for staying with me for so long. It's been
Hey, Param, I
90
have
minutes.
one last question,
Yes, hi
if
Shri.
you don't mind.
No, because when Karunashri asked the question, I was actually thinking you were asking the question. So nice to see you on here. Go
Okay.
ahead. Mm.
No, I think you mentioned about negotiation about the property tax reduction with the Houston County, I guess.
Yeah. The Houston Housing Authority.
Mhm. Yeah. So is that factored into the numbers that you shared?
Yes.
Or is
It's
okay,
already
and
factored in.
okay. And the other question is the insurability of the properties in Texas is becoming including California, right? It's becoming a painful aspect. How do you see this impacting future revenue coming in?
So we've already negotiated, we already have that in place. And so it depends on typically when you have a really large portfolio, we have so our partners, the Houston is their base. So they have multiple assets across Houston. And so it's not going to be an issue because they work with a vendor and they've had a long-standing relationship with them. I think it's more of a concern if you're getting into a new market without having an established base, it can be a little tricky. But that being said, there are vendors who are still active in those markets, and we haven't had those issues with either our multifamily assets or even in my personal portfolio because I own in Houston. That's where I started, and I own in California. And there are the providers who are still there. I think Florida has been a little trickier, more so than submarkets in California and Houston. But we have a long-standing relationship, with the insurance provider over there because of a very large portfolio that our partners have in Houston, and it's already in place, so we shouldn't have issues.
So it should, even if it goes up, it should be a fraction, not something that's going to significantly change.
It's already, the truth is it's already gone up significantly, and that has been factored in.
Okay.
And so the other thing is that we have that buffer of cash flow, right? So that's why it's nice to go in having like an average cash flow of 7% and having so that the new debt terms, we have the interest only period, so we're not paying principal. So all of that increases our buffer. So worst case, we're able to draw from the cash flow. The cash flow can go down, but we still are able to meet those payments, right? So that's why I say like the ability to hold on to the asset, a big part is the debt, but also like having high cash flow from day one. And so fortunately, like if we went in with 2% cash flow day one, and then the business plan is let's go in and rehab and increase the cash flow to 7%, that's risky. But we're going in day one, we'll even before closing, we'll have the the property tax exemption in place, hopefully. And so they're back to back, right? December 14th or 16th is when we're on the docket, and then the closing is right after that. So we usually like to get that in place before closing. So we'll go in with a high cash flow from day one, which will be close to like 5.5% at least. So even if expenses go up, we have the ability to draw from the cash flow to take care of that.
That's good to know. And I see only there are two classes of shares in this, right? Like compared to the past.
Yes, this one doesn't have that high cash flow position, Shri. Like, Blue Bonnet has a class A, which is like 10% cash flow. It has a more guaranteed position, but it doesn't get the profit split on the back end, right? So it's only for cash flow, but your overall return is also only going to be 10% annualized, right? So this doesn't have that. It only has that velocity of growth position, which is why when I compare those two deals, I said that, the risk return profile is slightly different. So the A and B in the Houston deal is like similar to the B and C in the deals where we've had those three classes.
Right. Okay. Thank you. I think I got my clarifications.
Perfect. Okay. Awesome. Valerie, nice to see you on here. I know I'm talking to you soon. And Kanesha, Dale, Hark. Okay, nice to see everyone. Hopefully this was helpful. Diane, I know you guys are still on here. Hopefully you got all your questions answered. Richard, I'm excited because I know you're joining us on this opportunity. Helen, nice to see everyone. Okay, I'm gonna hop off if no one has any other questions. I hope this was useful. And then again, the replay is going to be available in a little bit. And you can, if you want to hop on a call, just go to gwcapital.com and book a call with us. Okay. Thank you, Nick, Ben, Indra, Adrian. Thank you so much, guys. Thank you for staying on. I'm going to hop off now.